Welcome to Highway Herald, your roadmap to the latest in auto. Today, we're diving into the current state of the Chinese automotive market, which, much like the country's economy, is hitting a speed bump. After reaching its zenith in 2017, the market has been on a downward trajectory. The electric vehicle sector hasn't been spared either, with growth decelerating significantly over the past year. EV manufacturers are feeling the pinch as they grapple with an oversaturated market and dwindling sales. The situation is so dire that even industry leaders like BYD are feeling the heat. Let's shift gears and talk about the BYD February Fall. The Chinese EV industry is currently navigating a challenging landscape. An oversupply of vehicles, coupled with an ongoing price war and difficulties in optimizing production costs, has led to a significant downturn. Even industry heavyweights are feeling the strain. For instance, BYD, one of the world's most promising EV manufacturers, saw its sales drop to around 50,000 EVs in February, a stark 40% decrease from January. While it might be tempting to dismiss this as a typical February slump, the reality is more complex. A year-on-year comparison reveals a 37% drop in sales from February 2023, underscoring the severity of the current decline. Despite BYD's rapid ascent in previous years, to the point where some speculated it was outselling Tesla in terms of EVs, the company is now grappling with its worst sales record since May 2022. BYD, renowned for its advanced battery technologies and significant role in the plug-in hybrid market, has also seen a considerable year-on-year drop. The company sold around 66,000 units last month, marking a 34% decrease from the previous year. In total, BYD sold nearly 122,000 EVs and plug-in hybrids last month, a 36% year-on-year decrease. This paints a sobering picture of the challenges facing the EV industry in China. The home turf challenge. The global slowdown in EV growth is particularly pronounced in the saturated Chinese market. Oversupply and domestic market constraints have led to full dealer lots and price cuts to stimulate sales. BYD, a major player, is not just boosting sales but also outmaneuvering competitors. However, BYD's over-reliance on the domestic market, where it sells 95% of its cars, is a significant misstep. Despite its global recognition, advanced technologies, and impressive sales and production capacity, BYD's expansion into foreign markets has been limited. The Chinese market is also slowing down, with growth rates falling short of expectations. BYD, like other EV manufacturers, is feeling the pinch. The company's decision to buy back its shares, increasing the amount of A shares by 100% at a cost of around $55.6 million, is a clear attempt to protect shareholders' interests and boost investor confidence. BYD's Plunge, a mirror to the Chinese EV market. BYD's Plunge isn't an isolated incident. The entire market is currently in a slump, a development somewhat anticipated after several years of explosive growth. The market share of electric vehicles and plug-in hybrids in the Chinese automotive market has risen to 37%, but it seems the days of rapid growth are behind us. For several consecutive years, plug-in vehicles have been doubling their market share, but in 2023, that growth was capped at 46%, and all signs point to an even slower pace in 2024. As we've mentioned, this percentage encompasses both EVs and plug-in hybrids. When we focus solely on EVs, the picture becomes even bleaker, with year-over-year growth hovering around 31%. As a result, EVs now make up 25% of the total market, while plug-in hybrids account for 12% of the market, thanks to a whopping 80% growth over the past year. This surge in plug-in hybrids is quite telling. It suggests that Chinese consumers aren't ready to completely abandon internal combustion engines and are still seeking transitional solutions. Plug-in hybrids are more affordable and convenient than EVs. Consequently, it's likely that EV growth will continue to decelerate in 2024, mirroring trends observed globally. Before we delve deeper, we invite you to subscribe to Highway Herald. Your backing fuels our passion to bring more content like this to you. Now let's shift gears and steer towards the next segment. The Chinese EV industry, a fading star. The Chinese EV industry was once a rising star, but it seems the inevitable has arrived. With over 500 registered EV manufacturers in a country as vast as China, the market was bound to reach saturation. In just a few years, the number dwindled to around 90. But even this figure doesn't truly reflect the state of the Chinese EV industry. Many of these companies are barely making sales. Reports suggest that a third of these remaining EV manufacturers sell fewer than 500 cars quarterly, making their future all too predictable. Simply put, the market is oversaturated, and with the current slowdown, it's clear where this is heading. Industry experts predict that many of these companies will soon declare bankruptcy. It's believed that only a select few EV manufacturers will weather the storm, considering that the top 10 sellers currently hold 80% of the market. According to the same data, only 20 companies operate at 60% or more of their production capacity. The wave of bankruptcy has already begun. Bankruptcy wave hits Chinese EV startups. As we've mentioned, a massive wave of bankruptcies is upon us. In fact, it's already started, with several companies filing for bankruptcy in recent months. Interestingly, many of these companies were big names, some of the most promising in China. Take Evergrande New Energy Auto, for example. This startup was part of the Evergrande Group, one of China's largest conglomerates. Despite having virtually unlimited resources and billions in investments, this EV manufacturer never managed to carve out a niche in the market. Its sales numbers were so dismal that when taking all the investments into account, it turns out that this startup lost $17 million on every EV it sold during its brief production history. Then there are companies like Letten. A decade ago, this company was ahead of Tesla in terms of sales numbers. Recently, it declared bankruptcy. The list of big names continues, with Neutron also gone. WM, despite its impressive technological achievements and a starting capacity of more than $5 billion, recently filed for bankruptcy. Finally, let's talk about NIO. This company had a fairly respectable fourth quarter in 2023, with over 50,000 units sold. However, that's still far from its full production capacity, and especially far from the point when EVs become profitable. This company lost around $2.9 billion last year, and the outlook for 2024 doesn't look much better. The final lap. Considering the current state of the Chinese EV industry, it's clear that a period of consolidation is upon us. Of the approximately 90 EV manufacturers remaining in China, the majority are operating well below their capacity, with only 20 companies utilizing 60% or more. The market is awash with EVs, and supply significantly outstrips demand. The top 10 EV sellers account for 80% of the Chinese EV market. Despite current struggles, BYD maintains a dominant position, followed by a handful of other reputable names. These companies are likely to survive, while the rest are heading in the same direction. The survival strategy for smaller EV manufacturers is to unite, suggesting a future filled with mergers and acquisitions. The CEO of Li Auto has already urged the government to intervene to prevent a wave of bankruptcies, warning of a sea of blood if companies don't band together. We mustn't overlook Chinese legacy automakers like Geely and MG. These companies, unlike BYD, have successfully penetrated various global markets, including Europe and Australia, enhancing their prospects for future growth. Thank you for joining us on this journey through the world of vehicles. Don't forget to subscribe to Highway Herald to stay up to date with the latest vehicle updates and upcoming videos. See you next time!